Some people thought that maybe the put was back on after the sell-off in December and then the change in stance from the Fed. Is that a realistic viewpoint? And is there also a Fed call that if things in China, the trade talks go well, and if the market continues to go higher, suddenly you'll be back on course to raise rates? Is it that easy to switch back and forth between hawkish and dovish?
No, I think the message, from my point of view, is that the normalization process in the United States is coming to an end. On rates, we've already raised rates about 225 basis points from where they were initially. On the balance sheet, we've got that decision hopefully coming up in the next couple of meetings. So I think we're in a good place today. We've had a lot of success, and people said it couldn't be done. We got the interest rate back up. We got the balance sheet. Reserves are down 40% from where they were. There are a lot of technical issues around the balance sheet, which we can talk about this morning. But basically, I think we're in a very good place today. We've got this muted inflation, no urgency for action. I think we're data dependent going forward.
You've had that viewpoint for a while, and asking you to speak for the Fed as a whole is probably not fair. But so your viewpoint may not have changed that we were approaching normalization. I think you thought that before some other people thought it.
Yeah.
Is that fair to say?
No, I think that's fair, but I like the decision here, and I'm hopeful that this will set up the U.S. economy for a good continued expansion. This expansion is going to be the longest in the post-war era as of June 2019. If we can get several more years out of this, it'd be very successful.
Were certain members of the Fed not firmly convicted in their opinions previously when they said we were a long way from neutral, or did the facts change and therefore they changed?
Joe, I was just so persuasive that they came around.
I wondered, yeah, you can't I've said that before. Do you want to just start with 90-90-90? Is that would you like to just begin your interview with I was right?
I think the biggest thing to keep in mind is that we've raised rates quite a bit here, 225 basis points off of the near zero levels. And, you think of other normalization periods that we've gone through, that's quite a bit. It seems like interest rates are low, but they're high compared to the global environment that we're in.
I guess I just meant, should we be scared that now that they seem to be more dovish, because they changed their opinion so quickly in January, should we be afraid they could change it again to being hawkish again at the slide? It seems unstable. Should we view it that way?
I think that this Phillips curve argument, which is the breakdown between the feedback between the real economy and inflation, is really starting to carry the day. Inflation just hasn't come around. We put in the muted inflation language. You had 2 years of blockbuster upside performance in the U.S. economy in 2017 and 2018. Everybody was surprised to the upside. We still didn't see any inflation in that environment. So I think that's got people backing off the idea that there's such a lockstep relationship between the real economy and inflation.
So the minutes, Jim, say that several participants think rate increases are necessary only if inflation outcomes were higher. And other participants say if the economy evolved as expected, you would raise rates anyway. I guess you're not in the latter camp, that you would be a guy who would raise rates only if inflation comes in higher than you expect.
Yeah, I'd want to watch the inflation numbers and the inflation expectations numbers, which have dwindled down and are kind of low here. I would like to see those improve. One of the things that we could do here with this policy is recenter inflation expectations more on our 2% target. They're too low compared to our 2% target right now. And no, I don't think, if the economy evolves as is expected, I actually think we're a little bit tight right here, a little bit too high with the rate. But I have a minority view on that compared to the committee, I'd say.
Let me ask you a question about the balance sheet. I don't want to get too much in the weeds here, but there is a question about what the right number is. We're at $4 trillion right now. You saw our survey, which I was surprised at how low that number was, showed market participants on average thought $2.8 trillion was where it was going to by the first quarter of 2021. Now, you guys are saying we're going to stop this year, which is still 2019. I've heard numbers like 3.7 would be where you'd end up, so another 300 billion. What can you tell us about where you think it ought to go to?
I think there's been a growing realization over the last 2 years, or maybe even in the last year, that the demand for reserves is much larger than we thought, and that's because of changes in the Dodd-Frank Act. Banks have to meet their liquidity coverage ratios and other matters, and because of that, the demand for reserves is quite a bit higher than we thought. So we're going to approach that very slowly, come down very slowly, and get to the right level of reserves, and that's going to mean a bigger balance sheet, that's for sure.
Can you give me a number?
I'd rather not give a number because I don't know where the chair is going to come down on this in the end. He has to fashion a consensus, so let's see, but so I'm not going to give you a number.
It's north of 3.5, though.
I'm not going to decide on that here, but we're going to continue to talk about this and see where it comes out.
How much?
If you want a number, project reserve demand for me. Tell me where the reserve demand is coming, a downward sloping curve, and then it hits some point where you're satiated with reserves. That's the point we'd like to find, but we don't want to go right there. We want to go there slowly.
So, but help us project it yourself.
What's that?
Can you help us project it yourself?
Or was that a rhetorical? Was that a rhetorical device that you're using to Steve to say that we don't know yet?
We don't know yet, and we want to be careful about approaching
I can
this point.
explain a little bit, which is that they changed the rules. It has nothing to do with the amount of reserves out there, but they changed the rules to require the banks to hold more high-quality stuff, and they happen to have a bigger balance sheet that has high-quality stuff in it. So it's unrelated, but it works out pretty well in your favor that you don't have to bring it down so much, right?
Yeah,
the
but
HQLA
reserves
rules
have come down 40%, so I think we have had success on this. So.